Hey, what's up guys? How you doing today? Today is Sunday and I am really excited to go over some mechanics. That's what we're going to be talking about. Before I get into that, I just want to share with you some stats. All right? This is going to be a pat on the shoulder for you guys, all right? I just want to show you what you've been doing, right? On the YouTube channel. Look, as of September 14th, right? The watch time that you guys have been doing, right? All totaled up, we're at 1,787 hours. Okay, the average watch time is 8 minutes, 17 seconds. We got 787 likes. We have eight dislikes. My girlfriend would like that number, the way I said it. She'll appreciate that. Inside joke, inside joke. But looks like we have a couple haters. Not too bad. I mean, not everyone's going to agree with you, right? And we have a total of 12,934 views. That is freaking awesome. I don't even know how that happened. But I can just tell you that alone is giving me the boost, the motivation, the energy to keep delivering to you every single day because I know that you're watching. It's like I know, right? And for all the people that have submitted a form to learn more about their personal finances, to become a master in their finances and have financial freedom, be debt free, all of the above, I want to thank you. Okay, you guys are really giving me a lot of work to do, and it's just I love working, especially in the thing that I love to do. So it's like, if I haven't reached out to you yet, don't worry, I will. I work on each individual case one at a time, and I put my heart into it so that when I do call you, I'm prepared, I'm ready. Okay? Now, with the mechanics of the YouTube channel, now I want to go into the mechanics of velocity banking because I've been getting some questions in the comments and I'm seeing some more confusion when it comes to making a chunk towards a debt and then how it would look like exactly like on the 30-day, okay, like, all right, I make a chunk payment, I get that part, I save interest on the other debt, okay, cool, I'm pulling from the line of credit, pay my expenses, dumping my paycheck, get it, cool. Where I'm getting held up at is as the line of credit is approaching a zero balance, do I still dump my whole paycheck in? Do I just dump whatever the balance is? So if I make $3,000 a month, but the line of credit only has a balance of $1,000, do you want me to dump my whole paycheck in, or just the balance, and then use the rest of my cash here to pay my expenses? Or do I keep pulling from the line of credit? Okay, we're gonna really tear this open a little bit. So we know what velocity banking does and what it is. If you're my loyal subscriber, you've been watching me. If you're here for the first time, welcome. I encourage you to watch some of my older videos on velocity banking because I'm not gonna really dive into what it is and how it works. Okay. So, we know how it works, we know what it is, we know our debt weapons, right? We can either use line of credits, HELOCs, credit cards, other people's money, okay? We get that part, all right? So, I'm going to explain, each one, how exactly does this thing look like? So, let's see how I can best explain this. let's say I'm making $3K a month, right? And my expenses $2,500 of expense, and the cash flow is $500. Okay? Cash flow $500. I'm going to work each one and kind of explain the mechanics behind it. So, with the line of credit, let's just assume that we have a line of credit, we have our debt weapon, we know our cash flow, we know our expenses, we know our income over here. Okay? So the moving parts, right? Before Velocity Banking starts, we have our checking account right here. Okay? And let's say we have a debt of $10,000. 10K debt that we're paying, a lot of interest on, amortize, whatever. If this line of credit has 5K, okay, I'm simply gonna make a withdrawal. Okay, and the way that works is with any credit union or bank, a couple ways to make withdrawals is either walking right into the bank, or they have an app. The apps is the real easy one. It's really quick, and the idea is you want to have your checking account linked to your debt weapon. You want it linked. You want to be able to make seamless transfers of deposits and withdrawals. Deposits and withdrawals, right? And you want to be able to do that at any time. Okay? So that's like key thing right there is you want seamless transfers. You want to link the accounts. The way you link them, you can link them right when you walk into the bank, or you can link them on the website. They have an option. Just go to linked accounts. Boom. Got that in place. All right. Awesome. If we pull 5 from here to make a chunk payment over here, right? We cut the debt in half. We got that part. Okay. Well, what gets confusing is when I go to dump this into the line of credit, which is going to bring the balance of an owed amount of like $2,000 or so, right? 5 minus 3, 2. That's how much we owe left. But we still need to make a withdrawal to pay our expenses. Okay? And let's say on the 30-day time scale. All right, let's see this. You know what? I'll go just like this. 30 days, right? So let's just say day 1, we made our chunk. All right? And halfway into the month, and then towards the end of the month, we're going to get 2 paychecks. Okay? So let's just say that you get paid bi-weekly, let's say. For this example, this person gets paid bi-weekly. They make $3K a month, so that's 1,500 paychecks. They took 5 from here, from the line of credit, right? We took 5K out. Boom. We satisfied the debt payment of whatever the 10K was. We do not have a bill due yet on this 5K. It won't be due till next month. Okay? You have expenses throughout the month, right? All these little lines are your expenses. Okay? We took 5K out. We're going to get our paychecks. Okay, the idea, here's where someone can get messed up now, is if you took your whole line of credit, right, and didn't have money to dump back in immediately. Okay, so when I'm talking with someone, when I'm meeting with someone, we're on the phone together, I need to make sure that you have money, like in your checking account, before we make that chunk, right? Because look, if I took 5K from the line of credit to make a payment, right, and let's just say I have an expense here, got an expense here, got an expense here. If what happens if I run out of money in the process? I haven't gotten paid yet, right? Especially for my people that are living paycheck to paycheck, and your cash flow is like so low, like almost nothing. That's why when I'm talking to you, I don't go into velocity banking just yet. We have to work on increasing our income or increasing our cash flow. That's why I go into, getting the W-4 filled out and getting a checking account and just other unique ways of bringing in extra cash, right? So that is something I want you to avoid if you're listening but you're not working with me. I don't want you to make that mistake where you make a chunk payment towards something after you've dumped your money into a line of credit and not have enough, so to speak, to pay your bills, because either A, you didn't have any cash flow to begin with, or B, you made too big of a chunk. Okay? So the way that I figure out my chunk payments on each case goes based off your cash flow for the year. Okay? So if you're cash flowing $500 like this scenario, that's $6,000. But notice how I only took a 5K chunk, right? Because in the example, all we have is a line of credit for 5K. Okay? If this person had a line of credit for 10K, I'm not going to take the whole 10 out. I would only take a max of 6, because their cash flow is $500 a month times 12, 6K. All right? Now, that is just some things to be aware of, and you might have to replay this to really identify the little scenarios where this can get a little bit tricky. And that's why most people don't look at this scenario, because it can be very confusing. I'm not going to lie to you. I've made mistakes myself where it's like, I was like, oh shoot, like I didn't make the right chunk amount, so therefore maybe I had to pay a little more interest on the debt I just borrowed. Okay? I have a video where I go over some velocity banking flaws. If you haven't watched that, go ahead and check that out. And I kind of go over the drawbacks of doing velocity banking, right? Because you really, really need to be on top of your game when it comes to doing this strategy. And that's why when you work with me, I put your numbers on the board, so it's like you can't mess up, right? You can't. This is how you do it, right? Here is another scenario of a HELOC. I'm working on a case right now where I'm using a HELOC as a debt weapon. We're waiting on approval. This person, you know who you are, so we're waiting on approval. If we get approved, cool. We're going to do velocity banking on a HELOC to pay the mortgage off. And then I think a car note and some other debts. But same scenario. We take our cash flow for the year. That'll be our initial chunk payment towards the debt. The idea is that whatever current money is in the checking account plus the money that you're going to get paid throughout the month, before we use this cash, before we use cash to pay the expenses, we're going to use the line of credit, the HELOC. Okay, we're going to dump this 2 paychecks back into the HELOC. When the bill comes up, I make a small transfer of whatever the bill amount is, not more, not less, the amount that it is for that specific bill on that specific date. Okay? Now, same thing. Let's just say on the timeline that we've made a chunk payment. Okay, we're doing velocity banking, we're rocking and rolling. Okay, and we're approaching a zero balance on the debt weapon or on the line of credit, right? And you're like, okay, now that my cash flow went up, I have all this cash in my checking account. Do I dump it all in the line of credit to make the next chunk, or do I only chunk what's left on the line of credit? And the answer is you only make a chunk of whatever outstanding balance is left on your debt weapon, because now that'll give us the ability to make the next chunk. Okay? Now this is assuming that we've made our chunk payment for the year, or however our time scale works on your scenario. Okay? We're approaching zero balance on our debt weapon. Okay? Let's say we paid off the other debt. So that's an increase in cash flow. You'll see it in your paycheck. You'll be like, okay, I got increased cash flow of this. Now you have to satisfy the line of credit. Let's say there's only $1,000 left. Okay, $1,000. I'm just gonna take from my checking account, and I'm gonna zero it out so I don't pay any interest. I'm gonna zero it out. Boom. Now that it's zeroed out, you're like, okay, do I pull from the line of credit to pay my expenses for that month? Or do I just pay my expenses from my checking account? Here are your options. Yes, pay it from the checking account. Or if you have another debt that we want to tackle, or we need to continue to tackle the same debt that we initially chunked on, or whatever the case, then yes, we're going to pull from the line of credit, okay, to make the very next chunk on a specific debt, and we dump the cash into the line of credit and then pull from the line of credit again to start paying expenses, and now you restart the velocity banking. You restart it. It's restarting. Boom. Alright? So that's how the line of credit and the HELOC works. Hope I'm pretty clear on that. Moving forward into credit cards is where we get a little bit tricky, and I had a couple questions in the comments about, Denzel, how do I pay my auto loan, my rent, my things that you have to pay with a debit card that require a routing and account number? When it comes to credit cards, my friend, okay? When it comes to credit cards, there are only there are only a few things that you can't pay with credit, right? And that's usually like rent, the mortgage, the car payment, a loan, student loans, right? You can't pay credit with credit, okay? It doesn't work, all right? The only way it works hear me out, the only way it works is when you make a balance transfer or you use convenience checks. Now, this can be a strategy. I don't love it, right? Because you still have to pay the 3% fee, right, to withdraw that money. And all that money you withdrew, okay, you have to make sure that you have the income to pay it right back. If not, if you don't have a promotion tied to it, like a 0% for 24 months or so, you're going to be paying through your teeth in fees and interest. You don't want that to happen. Velocity banking will fall on you. You don't want that to happen, okay? So with credit cards, it's I have a few cases right now where, and you've seen some of my videos where I use velocity banking with a credit card. Now, if you pay attention, you notice how I take certain expenses, right? I take certain expenses to chunk at the credit card itself that I'm going to be using, right? So to make that a little bit clearer is if I have a credit card that I owe $5,000 on, okay, let's say I have a $5,000, oh no, dying on me? Damn. Let me check this out. So if I got a $5K credit card, alright, that I already owe money on, okay, I got a couple of cases like this where it's like you're already making a minimum payment, paying interest on it. How do we chunk at that, but also use that to pay our expenses? Right? That's where I've seen a little bit of confusion in some of my videos in the comments. So I would take our gas bill for the month, food, right, miscellaneous, the credit card payment itself, okay, and whatever that number would total up to is what I'm going to pull from the checking account, right, along with my cash flow, along with money that I'm saving, along with money that I'm redirecting, along with, the W-4, the, checking account promotions, any and all extra income will get added to this, dumped into the credit card, and then I'm going to swipe the credit card throughout the month, that 30-day time scale throughout the month to pay the expenses, right? And for the things that I can't pay with a credit card, guess what? The cash will stay in cash, in the checking account. And you'll just have your auto pay or whatever set up right through there. Alright? Now, Denzel. Okay, cool. I make the chunk. I withdraw, from the credit card. I'm paying the expenses. Okay. How does it work as the balance is approaching zero, right? Like if there's a couple, like a thousand or so left, don't worry. What's nice with credit cards is you won't be getting charged any interest, right? Because when you swipe the card, right, you won't actually owe it till 30 days down the road before it even accrues interest. That's where credit cards have their benefit. Whereas when you immediately pull from a line of credit or a HELOC, you immediately start to pay interest. That's why we need to make strategic chunks towards another debt to have cushion, like I say, cushion to offset interest that I would have paid on the line of credit. With credit cards, as soon as you make the chunk, you cancel the interest from accruing. You satisfy the month's payment. You won't have a bill till next month, But by next month, you would have already ran the card up, right, to pay your bills, and then you would have already made a payment which would satisfy the next month's payment, right? So when that due date actually approaches, or the closing date, right, you won't get charged interest on the whole $5,000. It'll be much, much less, and that's where you get that offsetting effect, where you're offsetting interest. That's cash flow. Guess what? That cash flow stays in the credit card. So, I hope I was clear with this. I know it can be confusing. That's why I tell people, fill out my form. Let me help you out. Let's figure out if we're even ready to do velocity banking, right? Because in order for velocity banking to work, we must have cash flow. We must. Or the formula, the equation will fall on us. We fall into that Peter to pay Paul method, and that doesn't work, right? Because you're still left with one of the two that you have to pay money on. All right? So I hope that makes sense. That's about it. That is mechanics, inside looks at debt weapons, the accounts that we're linking to the debt weapon, okay? How the balances work, what to do when you're approaching zero. Your options are zero it out completely and be done with it, or get ready to make the next chunk towards the next debt, or continuing, like if it was a mortgage, continuing, right? So my name is Denzel. Thank you guys. I appreciate your support every single day watching my content. I love you guys. Enjoy the rest of your day. Thank you.